Hello, everyone. Welcome to Caring.com's Digital Marketing Academy and our next webinar on the state of the housing market in 2016. Thanks for joining us today. Before we get going, as usual, we'll cover a few housekeeping items. We will be sending out the presentation, so you'll get it in email and you'll have a link to the recording if you'd like to listen again or forward to other ones of your colleagues who couldn't join us today. Also, as usual, this is a one-way webcast, but we do encourage you to ask questions. You can use the question tool that should be appearing at the right-hand side of your screen. Just type in your question and we'll take it, and I'll ask Greg at the end of our session. And as usual, you get the commercial. I'm sorry to do this to you, but this webinar is brought to you by Caring.com. We are the leading website for people caring for an elderly loved one. We have well over 100,000 consumer reviews. We get 3 million visitors every month to our site. Virtually all of them actively caring for an elderly loved one. We have tens of thousands of listings of all different types of senior care, including housing, in-home care, and consulting functions, thousands of original articles, dozens of online support groups, and we are part of Bankrate, a big public company that also includes the website Bankrate.com. And I'm thrilled today to be joined by Greg McBride, who is the Senior Vice President and Chief Financial Analyst for Bankrate.com. Greg is a media star. He's on TV all the time. I actually heard him this morning on my drive-in on the radio talking about payday loans. So if you have never caught one of his segments on consumer finance, I encourage you to Google him. He's appeared on hundreds of national cable and network broadcasts, including NBC's Nightly News, the CBS Evening News, Fox News, Fox Business Network. He's on the radio. He's a public speaker and has appeared before audience at the Federal Reserve Board, the Federal Trade Commission, and all over the world. So, and he's a super nice guy. So I'm thrilled to have him as a colleague, and I'm very happy to turn the presentation over to him and let him talk to you a little bit about the state of the consumer housing market. So bear with us for a minute. We're going to switch decks here. Okay, Greg, you are the driver.
All right. Thank you very much, Katie. Thank you for that kind introduction. Good morning, good afternoon, everyone, depending on where you are. Appreciate your time today. I've got just some thoughts I'll share with you in terms of what we're seeing with regard to the state of the housing market at this point. And then we have plenty of time for Q&A. There are a number of questions that were already submitted, so we'll definitely tackle those. And any additional questions that you have, as Katie said, just submit those, and we will definitely tackle those as well. So as we get started, the housing market, mortgage rates have not been an issue. Mortgage rates, just in time for our webinar, actually hit 3-year lows just yesterday. We're in a year when mortgage rates were really forecast to increase, we've seen quite the opposite. Mortgage rates actually hovering pretty close to record lows right now. They're only about 0.2 of a percentage point off of record lows that were seen back in 2013. So, mortgage rates are very, very low, very conducive to home buying, very conducive for people that are existing homeowners that are looking to refinance. The problem that the housing market has continued to encounter, though, is this limited inventory of homes that are available for sale. You look at the chart there on existing home sales. That level that you see, I mean, you kind of smooth out the month volatility, but that level that we're at right now is only about 70% of the record high back in 2005 in terms of the number of existing home sales every year. And it's not that we necessarily want to replicate the craziness of 2005, but it's important to note that we have 27 million more people in the country now than we did back in 2005. So the fact that we're at 70% of a record high that was established with a smaller population, I think is of note. And it's just one of those reasons why throughout the economic recovery, people have been kind of waiting for home sales and the housing market in general to just kind of grab a higher gear and take off. It really, it hasn't happened. It's been, a consistent and solid contributor to the economy, but it just hasn't grabbed that higher gear. Even on the home building side, housing starts, they're running at about 75% of the average pace that we've seen over the last 50 years. So, income growth is a positive indicator for some of those move-up buyers in particular. So I think, as we're starting to see that a little bit broader now in the economy, the income growth, I think that bodes well for housing in the sense that, a lot of people that may have been hesitant to make that move, hesitant to put their house on the market and make that move-up purchase because they weren't seeing more money in the paycheck. When they're seeing more money in the paycheck, that's sort of the final straw that says, okay, all right, now we can do it. So, time will tell on that. But, it's been a market that we've seen pretty consistent price appreciation, obviously at varying rates. Some parts of the country at a much faster rate than others. But, people are seeing the value of their homes increase. People feel better about their net worth because of that. Consumers are very squeamish about the stock market, but they are consistently reporting higher net worth year after year after year. Throughout this economic recovery, and a lot of that is attributable to the fact that the value of their home is going up. There is a wealth effect there from the additional to equity. People are also regaining equity. People that have been in their house a long time and they saw the value of it fall sharply during the housing bust. As home prices have kind of clawed their way back over the last several years to the economic recovery, those people are getting some of that lost equity back. And that's important for a few reasons. It facilitates that move when somebody does want to move. Having an equity cushion there is that down payment on the next home. It's the cushion to absorb transaction costs. But it also facilitates home improvements for people that are staying in their home. So definite positives for the housing market in both senses. It's still very much a seller's market. That again, a lot of that chalked up to the limited inventory, the fact that prices keep going up, the fact that you've got a smaller pool of potential homeowners now. Yes, we have a larger population, but the rate of homeownership has actually fallen back down to about 63%. So it's still a very favorable market for sellers, which I think makes a favorable environment for downsizing, and for many of your clients, the home health care needs or are looking to transition into a senior living facility. I think the environment where they're looking to downsize in one fashion or another, it's very positive for that. It's sort of the only real obstacle you see there is of a regional nature. You look at a place like California, for example. Somebody who's been a long-time resident in their home and has this massive capital gain on their house, that's a pretty significant tax bill when they sell. And so, that can be an obstacle, basically keeping people in their house. People getting priced out of their house isn't the risk, but getting saddled to it in that case, could be a factor. I mentioned those move-up buyers a minute ago. The fact that income growth could really be what really sort of breaks the dam there. The things that have not been obstacles are mortgage rates, as we mentioned, and then also credit availability. I have to say this is one of the most overstated things I run across in this, and I know you've heard it from everybody from Fed Chairwoman Janet Yellen on down that, well, you can't get a loan unless you have pristine credit. And, that's just flat out untrue. We see much greater credit availability, and as you can see there by the chart from the Mortgage Bankers Association, they actually track this on a monthly basis. And so, yeah, we've seen a little bit of tightening of credit here, in the last 9 months or so, but most of that is confined to jumbo mortgages, loans that are held in portfolio. The government loan programs have not seen that tightening of credit. We've actually seen more of these low down payment programs coming to market. And so, getting a mortgage typically requires 3 things: good credit, proof of income, and money for a down payment. And most people, particularly people that are buying houses, credit is not the issue. The median credit score is high enough that people are going to get some of the best rates they've ever seen. That's not the obstacle for most would-be home buyers. The proof of income isn't either. I mean, with the exception of small business owners, where it is admittedly a challenge, and that's really the roadblock that they often run into, is that inability to show the income needed to qualify. Most people have paychecks and tax returns that can prove their incomes. The obstacle for most people is that they don't have an extra 25 or 30 grand laying around to make that down payment. And so that's why you're seeing more and more of these low down payment programs come out. We've initially seen them through the government programs. You're now even seeing some partnerships between the private sector and the nonprofit sector to bring more of these low down payment or even no down payment programs to market in an effort to get the first-time home buyer in the market, really kind of add some juice to the housing market. So the things that have not been obstacles for trade-up buyers are mortgage rates and the availability of credit. But as I mentioned, what has been an obstacle is that stagnant income. Until people see more money in the paycheck, they don't feel like the economic recovery has really landed on their doorstep. The other obstacle for some people I touched on a moment ago was just the equity position. People that have little in the way of equity, not enough to absorb the transaction costs of selling, or not enough to make a substantive down payment on the next home. That can be an issue, but that's more and more people are finding themselves in a better position over the course of the last couple of years as home prices have worked their way higher. I see that continuing. The home prices continuing to go up and facilitate that better equity position down the road than what people have now and have had for the last few years. One of the other things I want to touch on, and I think this probably pertains mostly to home health care clients, is the notion of reverse mortgages. And this is another thing that really sort of bothers me, is that reverse mortgages have for some reason gotten a nasty reputation among people, to the point where when you mention it, people sort of, they grimace a little bit, right? They kind of recoil in their chair a little bit. And when you ask them why, oftentimes it's because they read a newspaper article about some little old lady that lost her house because she couldn't pay her property taxes. And I remind them that has nothing to do with the reverse mortgage. If the rest of us don't pay our property taxes, we're going to get thrown out of that house. So, the fact is, there have been, the product itself is going to be a lifeline for millions of boomers in the years ahead, simply because they don't have a few hundred grand in their 401k, but they may have a few hundred grand in home equity, and that's how they're going to unlock that value is through the reverse mortgage. But there's also been new rules put into place on reverse mortgages that offer further protection for seniors. So, again, a lot of those, sort of knocks against the product from years past, even if, they weren't entirely accurate, there are even further safeguards in place to protect against them. For example, there are limits on the amount of the lump sum that the borrower could take, the reverse mortgage borrower could take at closing. So basically, they can't, drain all of their potential value out at the outset, blow the money, and then not have anything to fall back on later. There are arrangements made for escrow for taxes and insurance, so that particularly seniors that are living on a fixed income, maybe a little bit strapped, that ability to pay property taxes and property insurance doesn't become a burden, jeopardizes their status as a homeowner. Also, protection for non-owner spouses. You know, this is the other sort of newspaper article people have seen, is the, you know, borrower that took the reverse mortgage and then they later passed away and their spouse was forced to sell the home. And, you know, what often happened there was the surviving spouse was not an owner of the property. So, you know, maybe it was, you know, a second marriage or something, for example. And in particular, if it was a younger spouse who wasn't of age to get a reverse mortgage, you know, that had been a problem in the past. There are now further protections in place to protect those non-owner spouses. The other thing is, and I find a misunderstanding that people have about reverse mortgages that, you know, I think is something that needs to be cleared up, is that you're not on the hook. Neither the owner or their heirs are not on the hook if down the road they end up being upside down. If the accumulated balance on that reverse mortgage is greater than the market value of the property when it's sold, they're not on the hook for the difference. There's an insurance premium in place to protect them from that. So, you know, I think reverse mortgages, you know, I think the outlook is good, and I think that you know, a healthy housing market is certainly good for that product, but I also think it's going to be, in addition to being a lifeline for retirees, I think it's something that more and more people are going to be looking at in the home health care context. That, you know, people that their budgets are tight, but they have some additional costs for, you know, home health care or things that insurance is not covering, that they need to absorb. The reverse mortgage going to increasingly, I think, be the avenue through which people are able to extract that. And just, you know, to close, I wanted to touch on, you know, something else, and that's, you know, with regard to, you know, what we hear a lot about millennials and, you know, the fact that they're not buying houses, and they're not buying houses at the same pace that their predecessors did at the same age. And, you know, there's a lot of gnashing of teeth about that in the real estate industry. You know, we do a lot of consumer polling, so we've got a lot of great insight into the financial standing and the financial state of mind of consumers of various ages. And I have to tell you, we see a lot of very positive indicators among millennials in particular. They're less consumption focused than their predecessors. They have a greater inclination towards saving. And so this idea that they're not buying houses in their 20s like their predecessors did, I don't view that as a bad thing, because of some of those other indicators that we're seeing. We're seeing that they're valuing career mobility, that you know, they're building a financial base. Now, we've actually found that adults in their 20s are more likely to have some money squirreled away in savings than adults in their 30s. You know, which again I think is a vestige of the financial crisis. People that had a front row seat for it and saw the impact it had on their parents, it's really resonated with them. And so we do see a greater inclination towards saving, and so they're building that financial base. They're also starting to save for retirement at an earlier age than any of their predecessors. So they're building that financial base that I think you know, will ultimately bear fruit in terms of the housing market, in the sense that the millennials that aren't buying in their 20s, I think they will be buying when they get to their mid-30s, and, you know, things have changed and now they have a family, and, you know, all of a sudden having that loft in an urban downtown area isn't so attractive. They're going to want a place in the suburbs with a backyard and a garage. So, but by virtue of making the sort of investments they did in their 20s, investments in their career through the career mobility, the building that savings cushion, putting themselves in a better financial position and avoiding debt, they're going to skip right over the starter home phase, and they're going to go, you know, right into sort of the place where they put roots down. So yes, the initial buy may be delayed, but I think ultimately they're going to buy, and they're going to buy a bigger house than they otherwise would have. So that's yeah, just a, you know, sort of a quick outlook of sort of, you know, where the housing market, you know, is now. I think there are a lot of positive indicators going forward, and you know, a lot of the elements that I think are in place now will continue to be in place. I don't necessarily see, this environment of low mortgage rates, for example. Even if mortgage rates tick up a little bit, say over the course of at some point in the next 12 months, we're still looking at mortgage rates that are going to be, at that point, they would still be in the low 4s. So very conducive to home ownership. And so, as long as the economy continues to kind of keep plodding along, you've got unemployment below 5%. You see a lot of the, I think, positive factors in place that bode well for housing. We do have a number of questions that had previously been submitted, and so I think some of them are tie in pretty close to what we've been talking about the last few minutes. So I'll jump into those, and Katie, at the point where there are any others that we want to cover, just let me know.
Yep, absolutely.
All right. First one we have here is, how does this year's market compare to last year's, meaning real estate market? I think they are very, very similar. Credit's gotten a little tighter on the higher end properties because we have seen some softening on the high end market in some parts of the country, but for first-time home buyers, middle-class households, you've got more credit availability, more of those low down payment programs are coming to market. So, and it's still that seller's market, sort of highlighted by limited inventory. So I think a situation this year that's not a whole lot different than it was last year, other than maybe you've seen some additional softening on the high end of the market. Another question was, can your data be more specific to area or region? At Bankrate.com, we gather data on mortgage rates and fees, various terms, even closing costs, all over the country. So we actually publish data on mortgage rates and terms in 650 markets all over the U.S. So you can get a very localized quote when you come to our site. We also survey average closing costs in all 50 states plus Washington, D.C. So the aim is, we definitely want to cover the country from coast to coast.
Greg, are there, on the topic of regions, are there particular parts of the country that are either really hot now for real estate or really sort of dragging?
A lot of that is tied to the job market in the respective areas. So for example, some of the Rust Belt cities, valuations are really attractive, but where job growth is lagging, home prices are as well. So definitely a very close tie in there. Of course, those of you in the Bay Area, you've seen something the exact opposite. Home prices are continue to go up by leaps and bounds. The job market is super strong, and there's a lot of money sloshing around Silicon Valley. Next question we have is, I'm 59. Is it better to remodel or put $250,000 equity toward a new home with a new mortgage? I don't know if this is a financial question as much as it's a lifestyle question. Here what you have to assess is, does your current home, either now or once you do that remodeling, does that meet your needs for the next 5 to 10 years? So, unless the answer to that question is no, I'd be wary of incurring 2 sets of transaction costs, each at tens of thousands of dollars, to move from one home to the next. If the current home is going to continue to meet your lifestyle needs over the next 5 to 10 years, in this attractive financing environment, doing a remodel, may certainly be the path of least resistance. Next question is, should I sell now or hold out and get a better price in the future? That question comes up all the time. The thing is, prices tend to move higher over time, but on average, not much faster than inflation. They may run ahead of inflation for a period of time, well ahead of inflation for a period of time, but then there's always this sort of reversion to the mean. And so over time, home prices tend to increase at a pace that's about a percentage point or 2 faster than inflation. So, in those markets where appreciation has outpaced inflation by a wider margin over the last several years, I think the appreciation pace in the next 5 to 10 years is going to fall more in line with the actual rate of inflation. So I still think home prices are going to go up, and they're going to go up, in most, if not all, markets over time. But it's going to be at varying paces, and particularly in areas where they've gone up at a faster pace recently. I would not expect that to continue on an indefinite basis. But but ultimately, that decision on when to sell, that's driven by life stage and lifestyle. It's not necessarily a price-driven decision as much as it's is your family, do you have a growing family that requires you to buy a home or buy a bigger home? Do you now have the empty nest that facilitates a downsize? Are you relocating for a job? Are you moving into retirement? Are there health issues or aging considerations that come into play? I think those are the real factors that dictate when is the appropriate time to make a move. Next question is very interested in how who wins the election will affect interest rates, housing prices, and senior living. It's very hard to say at this point, and I'm sure if, for example, if we look over the next 12 months, I'm not sure there's going to be much effect on home prices and senior living, based on the election outcome, or at least until we have better understanding what their platforms are, or there's legislation that's actually being put into place. I think those would be the real drivers. But campaign promises aren't something that are going to have much of an impact on home prices, or senior living as I see it. Interest rates, on the other hand, they are, particularly in the short term, and we're seeing this now, is they're subject to fear and uncertainty. And that's one of the reasons why mortgage rates are at 3-year lows right now, is because financial markets have been kind of tied in a knot over this notion of the Brexit, this vote next week about whether or not the United Kingdom is going to stay in the European Union or not. Something that has zero effect on the U.S. economy, but it's impacting financial markets around the globe, and so that sort of fear and uncertainty in financial markets, translates into lower interest rates, lower mortgage rates. So, even once we move past that, there's going to be a sufficient amount of uncertainty with regard to the presidential election, with regard to the Federal Reserve, or just the broader economy through the balance of the year. So, I would expect we're going to see some continued fluctuation in mortgage rates through the balance of the year, as the outcome of the election and the respective agendas of either candidate, as the uncertainty about that peaks and then finally recedes. Next, what about the living in community and aging in place for the boomers? How will the housing market change to meet those? I think you're already starting to see, from a new construction standpoint, some focus on less square footage, mid-sized homes rather than McMansions. Also, there's greater functionality for multi-generational living needs within the same home. We touched earlier on millennials. Again, I think over time they will translate into home ownership. So I think the concern that many boomers have about, well, who's going to buy my house when I want to downsize, depending upon your time frame, I think there's going to be a viable market for that, for sure. I'm not convinced that the current attraction that we're seeing to urban living, I'm talking about sort of downtown type living. I'm not convinced that that's a permanent one. I know in particular with the millennials being big on that now. Again, give them another 10 years, a dog and a kid or two, and I think they're going to feel differently. Next question. Many seniors want to downsize homes prior to moving to assisted living and cut costs. What options exist for this, renting or a smaller home? And I would say yes, both of those, both renting and the smaller home. The one caution I would add is that rental markets have been very tight. Rents in many markets are increasing faster than home prices. So a lot of places the value is very much in favor of buying rather than renting. So that downsize I think is more conducive to sort of buying the smaller home where you control your own destiny from a cost standpoint, as opposed to renting, where you're going to subject yourself to potential further increases, which can obviously be a real strain for anybody living on fixed income. Next question: what trends do I see on the horizon for baby boomers? As I mentioned a few minutes ago, I think this is the group that's really going to take to reverse mortgages as they move into retirement age, as they get to 62 and beyond. It just, it's going to be a lifeline, because that's where the bulk of household wealth for middle class and lower income households is tied up, is in the home. It's not in their 401ks or their IRAs. So, I think, the other thing is that shift from McMansions, which was really the focus of home builders 10 years ago, now to more mid-size homes. I think that's one that is geared in part toward that downsizing boomer generation. This is the last question I have here. It was submitted ahead of time. How strong is the likelihood that real estate prices continue to increase over the next 2 to 5 years, especially for California? For most parts of the country, I'd expect residential real estate prices to be consistently higher each of the next several years. As I said earlier, I think the elements in place now will remain in place. The elements that are conducive to the housing market continuing to grow at a steady pace, I think those are in place. I think the likelihood points to a modest low to mid single-digit pace of appreciation, not much higher than inflation in most of the country. There's certainly the possibility that we could see another sort of mini boom, housing boom, if you will. It's possible. I don't think that's the greatest likelihood. The question specifically asked about California. I have to say, the valuations of the California real estate market make no sense to me whatsoever. The Bay Area in particular, and I've got family out there, so I kind of know that market, fairly well, considering I don't live there. Bay Area in particular, if at some point, if there's less money sloshing around Silicon Valley, prices in that area of the country could definitely come under some pressure. So, I mean, that's not a prediction; it's just a contingency to watch for. That there's been a lot of money out there the past few years, and if there's any type of sort of squeeze on financing, that could have a big ripple effect that does affect the housing market. For somebody who is looking to buy now out in the Bay Area in particular, I'd say your risk is definitely to the downside more than potential upside benefit. So, sorry, I know that's probably not what some of you wanted to hear, those of you that live in Northern California in particular.
Greg, a couple more questions have come in. Here's one. Since memory care is private pay, are you seeing senior couples using an HECM loan to pay for memory care? So this is sort of getting into what you were talking about possibly reverse mortgages. If you had one spouse who needed memory care and another who didn't, that might be a place where you could use either a home equity loan or a reverse mortgage. Have you ever seen that or thought about that?
Well, I really on both fronts. I think certainly both are conducive to that. I think that there is particular appeal on the reverse mortgage because the benefit there is it doesn't result in a monthly payment, right? It's not another monthly obligation that you have to make. In fact, if anything, it can decrease your monthly obligations by virtue of the fact that when you get a reverse mortgage, the first thing it does is it pays off any existing mortgage that you have on the home, and so eliminates that monthly payment. So, which is again very valuable to seniors, creates a lot of breathing room in their budgets. So I think there's particular appeal there on the reverse mortgage. But look, for somebody who didn't want to go that route, or maybe it's the adult child that's actually financing it for the parent, so they're not at age 62 to even be eligible for a reverse mortgage. Then yes, home equity is a viable alternative. Home equity really has picked up some steam. Home equity borrowing has really picked up some steam over the past few years because of the fact that we've seen home prices recovering. We've had a low interest rate environment, and it's been an environment where home buying activity's been at a slower than typical pace. So more people are staying in their homes. So they have greater equity. They expect that they're going to be there, and so you marry that to a low interest rate environment. It's certainly been very conducive to home equity borrowing. And as we saw yesterday from the Federal Reserve, interest rates aren't going to go racing higher. So that attractive financing environment for home equity borrowing in particular is going to remain intact for the foreseeable future.
Okay, and then this is a question from me. I'm thinking about your sessions in recent days on payday loans. There are lots of other ways to finance a senior housing move besides selling your home or taking out a reverse mortgage. Do you have any thoughts? This is a little bit off topic, but things like life insurance settlements or bridge loans that people might get to tide them over between the time they want to move into a senior community and the time they would sell their home. Do you have any thoughts on those or trends that you're seeing on those?
Not a great deal. I think that one thing I would sort of caution is that for some of those other products, it can actually put you at a disadvantage if, for example, if you're coming across as somebody who's desperate for cash or somebody who really has a pressing short-term need and doesn't have a whole lot of other options. That's just not a favorable position to be in. So particularly in an environment where interest rates are so low and traditional financing methods are so, I think, attractive. I'd say certainly exhaust those avenues first. Savings, accumulated savings. Some have sort of insured against that eventuality with longevity annuities, for example, that kick in when they get into their 80s. I think you're seeing instances where that's certainly being applied in the market as well. And then people that are just sort of taking money off the table. You've got the stock market that as of a week ago was within 2% of or 1.5% of a record high. Investors, older investors that may have some of those needs in the future, taking money off the table. Certainly another way that people are financing those needs.
Okay. Terrific. Well, thank you so much. That exhausts our questions. Just quickly before we leave, I wanted to put in a plug for our next webinar. It'll be Thursday, July 21st, and we'll focus on measuring ROI for internet leads. This will be a repeat of a very popular webinar we did a couple of years ago, so come join us again, and we'll talk through how do you calculate ROI for internet leads and any other marketing that you're doing. Thanks, everyone. We look forward to joining you again in July, and thank you so much, Greg, for taking time to talk to us today.
Thank you, Katie, and thank you, everybody, for dialing in.
Bye-bye.